Welcome to the deep dive. It is Tuesday, May 27th, and yeah, definitely shaking off that long weekend feeling here.
Feels like it. The stock market was closed yesterday, Memorial Day, of course.
Right, and the U.S. bond market even knocked off early last Friday.
A bit of a breather for traders, maybe, but the underlying market forces,
Right.
they definitely didn't take the whole weekend off. Lots happening under the surface.
Exactly, and that's what we're here for today. We've got this pile of articles, reports, notes, all the intel you shared. It covers the key stuff from last week and really sets the table for this week.
Yeah, there's a lot to unpack.
So our mission is to jump into all this material, pull out the really crucial insights, and get you up to speed fast. We're talking the big fiscal debates in D.C., central bank moves globally, and yep, those trade tensions that just, boom, reappeared.
Think of it as us guiding you through the noise, finding what really matters and why, based straight on these sources we've got.
Okay, let's dive right in then. First stop, Washington. There's this legislative package getting a lot of chatter. The sources are calling it the big, beautiful bill.
Right, and it's not just one thing, is it? It's pretty broad. Tax breaks, spending cuts, a whole mix.
And the passage in the House was something else?
Oh, incredibly narrow.
Yep.
I mean, 215 to 214, that's about as close as it gets.
Wow. So what happens now? It goes to the Senate.
Exactly. Heads to the Senate now. And even though Republicans have a bit more breathing room there, majority-wise, the sources we're looking at really expect significant changes to be made. It's not sailing through as is.
And inside this bill, there's one piece that's making people, especially folks worried about debt, pretty nervous.
Yeah, that's the debt ceiling provision. The bill apparently includes language to raise it by something like $4 trillion.
$4 trillion, okay.
And tying that increase to this specific bill, well, it creates a real deadline. We've got the CBO, the Congressional Budget Office.
The nonpartisan scorekeepers.
Right. They're projecting the Treasury could actually run out of cash. Its ability to pay bills sometime around late July or maybe early August if that ceiling isn't lifted.
So it's not just political theater. There's a real fiscal cliff potentially looming there this summer. What else is packed into this bill?
Well, another key thing is it extends those Trump 1.0 tax cuts. Remember, they were set to expire end of 2025. This bill pushes that out. And any actual spending cuts, those seem to be pushed until after the next election cycle based on the text.
Okay, so how are the markets taking all this? The legislative fighting, the debt ceiling deadline, the tax changes?
Well, the sources are pretty consistent on this. This whole debate, especially around the debt ceiling and taxes, it's really ramped up what they're calling fiscal fears.
Fiscal fears, okay.
And that's seen as maybe the key reason why we've seen longer-term bond yields climbing recently.
So the market's looking ahead, seeing potentially a lot more U.S. debt coming down the pike and basically demanding higher interest rates to hold it. Is that the idea?
That's exactly the connection the sources are drawing.
Yeah.
And one report even cites a Moody's estimate.
Oh, yeah.
Suggesting that partly because of these tax changes, the U.S. deficit could climb from, 6.4% of GDP now to maybe 9% by 2035. That kind of trajectory, well, it definitely weighs on bond investors.
Okay, that's a pretty stark backdrop on the fiscal side. Let's connect that directly to the bond market itself. What actually happened last week with, say, Treasury auctions?
Right. So last week there was a U.S. Treasury auction for 20-year bonds, and the coupon rate was 5%.
5%. That's the highest since they brought that 20-year back in 2020, right?
It is, yeah. Highest since the reintroduction. You'd think 5% would attract a lot of buyers.
Yeah.
But the sources suggest the auction wasn't quite as strong as maybe hoped. Demand was okay, not stellar. And importantly, after that auction, yields on the long end, they actually ticked higher again.
Now, here's something the sources pointed out that I found really interesting. This usual link between bond yields and currencies. It might be, breaking down a bit?
Yeah, that's a key observation in a few places. Normally, higher yields in a country attract foreign money, pushes the currency up. Simple supply and demand.
The standard playbook.
Exactly.
Yeah.
But the analysis we're seeing suggests the U.S. dollar has actually been drifting lower, even while these Treasury yields are rising.
Why?
The thinking is that these more fundamental worries about the U.S. fiscal picture, about future growth, are kind of overriding that simple yield advantage for the dollar right now.
So the fiscal fears are actually hurting the dollar, even if yields are up.
That seems to be the view. And as long as those concerns are kicking around, the sources tend to think U.S. Treasury yields are, more likely to grind higher than lower.
Okay, so the bond market's sending a pretty complex signal there. Now, speaking of signals and maybe conflicting pressures, we heard reports President Trump wants the Fed to cut rates. what are the sources telling us about the Fed's likely thinking?
Yeah, despite that political pressure, the consensus view coming through the sources is pretty strong. The Fed is probably going to hold rates right where they are for, well, longer than maybe some people expect or hope.
Okay, and why? Is it still just inflation concerns, or?
It seems to be mainly about the incoming economic data. It's just remained, well, surprisingly solid.
Like what specifically?
Okay, so take the Flash Composite PMI, that's the Purchasing Managers Index, surveys business activity. It actually jumped pretty nicely in May, up to 52.1 from 50.6 in April.
And over 50 means expansion, right?
Correct. So that signals decent growth.
Yeah.
Plus, you look at initial jobless claims, they're still quite low. Suggest the labor market is tight. Put it together, and this data, this hard data, as the sources call it,
Yeah.
it just doesn't really scream imminent recession.
So no urgent need for the Fed to jump in and cut rates based on what they're seeing right now.
That seems to be the takeaway, yeah. As long as the economy looks reasonably resilient like this, there's just not much justification seen for the Fed to cut further. Some analysts quoted think we might not see the data soften enough to support cuts until maybe September.
September. Okay, that's still a ways off. Let's hop over to another key central bank, the Bank of Japan, the BOJ. What's going on there?
Well, there was some chatter last week, some speculation, that Japanese officials might be thinking about trimming back how much government debt they issue.
Why?
It came after some, frankly, quite poor bond auctions recently. Their 20-year bond sale, for instance, apparently saw pretty weak demand, which pushed yields up there.
Okay, so speculation about less supply coming from Japan. How did the rest of the world react?
Interestingly, it reportedly sparked a bit of a rally in global bond markets. Japanese 20-year yields themselves fell quite a bit on that news.
And that spilled over.
Yeah, even U.S. 10-year Treasury yields dipped lower following that BOJ speculation. It's just another reminder, isn't it, how connected these global bond markets really are. A potential policy shift in Tokyo can move yields in New York.
No kidding. And speaking of ripples, trade tensions certainly made some waves late last week and over the weekend. Seemed to come out of nowhere.
They really did flare up again. You had President Trump last Friday suddenly threatening a 50% tariff on the EU.
50%, wow. And also something about Apple.
Yeah, and a separate 25% levy specifically on Apple products.
Yeah.
That definitely got the market's attention heading into the long weekend.
I bet. So what happened next? Did those threats stick?
Well, the big development happened over the weekend. After talks with the European Commission President Ursula von der Leyen, President Trump agreed to delay that potential 50% EU tariff.
Delay it. To when?
Push the potential start date back from June 1st out to July 9th.
Okay, a delay. How did markets react to that news come Monday night, Tuesday morning?
Oh, it was a pretty significant relief rally, according to the sources. U.S. stock futures jumped quite sharply, basically erasing the losses they'd seen after the initial threat on Friday, back to where they were.
So, breathing room, at least for now. What about the EU side? Are they just, sitting back and waiting for July 9th?
No, not at all. The sources say the EU is actually ready to, quote, accelerate and fast-track trade talks with the U.S. now.
Oh, really?
Yeah, they apparently see this delay as creating, quote, new impetus. The plan, as described, is like a 6-week sprint.
A sprint on what?
Focusing on key sectors, but also trying to tackle those existing tariffs, the steel and aluminum ones that are still around, and other non-tariff barriers, too.
It feels a bit like we've seen this movie before. The pattern. Make a big, aggressive threat, then kind of step back to negotiate.
That pattern is definitely something the sources highlight, yeah. They see it as part of a potential negotiation strategy. There's also this view floating around in the analysis that maybe a baseline, like a 10% universal tariff on goods coming into the U.S., is possibly seen by the administration as sort of an established floor now.
An interesting perspective, like that's the starting point for talks. Now, here's a detail from one source that just blew my mind, showing the real-world scramble this causes.
What was that?
After that tariff pause was first hinted at, apparently daily container bookings from China to the U.S., they doubled.
Doubled between May 9th and 15th.
Yeah, just in that short window.
Wow. So U.S. importers are basically rushing to get stuff on the water before that potential July 9th deadline hits.
Exactly. And the sources point out that kind of surge could easily jam things up, cause congestion during the peak shipping season later this summer.
Yeah, that's a very tangible consequence, isn't it? Shows how quickly these high-level talks impact logistics on the ground or, well, on the ocean.
Definitely. And just quickly touching on the EU-UK relationship, the sources mention a few, maybe smaller, positive developments there.
Yeah, nothing earth-shattering, but some signs of, let's say, improving working relations.
Yeah.
Agreements recently on things like defense procurement, migration cooperation, some agricultural trade rules.
Like the fishing access thing.
Right, including EU fishermen getting access to UK waters for another 12 years. Small steps, maybe, but viewed as generally positive for relations and perhaps, slightly supportive for the pound and the euro down the line.
Okay, so a complicated trade picture, but negotiations are definitely back in focus. Let's widen the lens now. What other specific companies or market trends were making noise according to the sources?
Sure. There were a few notable company stories. Salesforce is reportedly in talks to buy Informatica.
Okay.
And Informatica's stock reacted pretty well to that news, up nearly 11%.
And a name that's often in the headlines, Trump Media.
Yeah, Trump Media and Technology Group, the ticker's DJT. It also saw a big jump, almost 11%. That followed reports it's looking to raise about $3 billion.
To do what?
Reportedly to buy cryptocurrencies. That was the plan mentioned.
Interesting. Okay. What about old economy stocks? U.S. Steel.
U.S. Steel had a huge day last Friday, up around 21%. That was after President Trump announced some kind of partnership involving them and Nippon Steel from Japan. Pulled back a little today, but Friday was big.
Gotcha. And in the auto world, any movers?
Stellantis was gaining today, maybe partly catching up after the holiday, but sources also linked it to that Trump tariff delay news, easing some worries for automakers.
Right. And speaking of autos, there was that really interesting global trend highlighted about EVs in Europe.
Oh, yeah, that was fascinating. BYD, the big Chinese EV maker.
Right.
Reportedly sold more cars in Europe than Tesla for the very first time. That was in April data.
Wow. First time ever.
Yeah. One source described it like two elevators crossing. BYD surging up, Tesla maybe trending down, at least in that specific European comparison for that month.
And this ties right back into the trade discussion, doesn't it? Because BYD faces potential EU tariffs.
Exactly. While Tesla makes cars in Europe, in Germany. So it really sets up this kind of real-world test case. How much will tariffs actually impact EV sales dynamics over there?
Yeah, that'll be key to watch. Did the sources say anything about the overall European car market?
Just that broader European car sales did dip a bit in April, and some sources linked that dip, partly at least, to that global trade uncertainty, maybe making consumers hesitant about big purchases like cars.
Makes sense. Okay, shifting gears a bit, the sources also included some useful reminders or insights about just, general investing concepts. Good stuff for listeners maybe newer to this.
Yeah, they touched on some basics like, different ways people try to make money in the market, different strategies. And for beginners, the idea of just using broad index funds came up.
Like an S&P 500 fund.
Exactly. Often suggested as a solid starting point. And ETFs got a really strong mention.
Exchange-traded funds. What was the take there?
They were really highlighted as, potentially simple, safe, effective tools used by rookies and pros alike. One source actually called them, in all caps, the investment everyone should do.
Huh. Okay, that's quite the endorsement.
It is. And yeah, you can definitely invest in ETFs, and the sources have tips on, how to find them, how to actually buy them.
Good practical stuff. Any other sort of investment mindsets mentioned?
There was that idea about buying quality stocks when they go on sale, essentially, when the price drops.
Like the sneaker analogy.
Yeah, exactly. Compared it to buying high-quality sneakers when they're discounted. The tragedy, the source said, isn't buying more when they're cheap, it's selling them.
I like that. Makes it tangible.
Me too.
Yeah.
And then, other approaches were listed too. Things like index universal life insurance policies, IULs, sometimes used for accumulation, or focusing on passive income through dividend stocks. And the idea that people often start with safer assets, cash, government bonds, corporate debt, before maybe moving into riskier things like stocks or even crypto.
Yeah.
Bitcoin was mentioned as sort of a risk-on barometer for sentiment.
A good overview of the landscape. And a really important reminder came through, too. Even if you don't actively invest yourself, what happens in these markets can still affect you, right?
Absolutely.
Yeah.
Through your pension fund, maybe, or just the overall health of the economy impacting jobs. It's not walled off. It touches, most people's lives in some way.
So true. Okay, let's bring it back to the week ahead then. As we navigate the rest of this week, what are the key data points, the key events that the sources say everyone's going to be watching?
Yeah, the big focus now shifts back to the U.S. economic picture and what it means for the Fed.
Yeah.
So data-wise, we've got durable goods orders, capital goods orders coming up.
Okay.
Consumer confidence numbers, another look at GDP growth, and then the really big one later in the week, the PCE price index.
Ah, PCE. That's the Fed's preferred inflation gauge, isn't it?
That's the one, yeah. Everyone watches that very closely for any signs inflation is picking up, cooling down, whatever. We also get the minutes from the last Fed meeting, the FOMC minutes.
That gives more color on their thinking.
Exactly. More detail on their discussions and debates during the last rate decision. That's out this week, too.
Any big company earnings still to come?
Yep. Nvidia reports this week. Given how huge they are, especially in the whole AI narrative,
Right.
that report always has the potential to move the entire market, not just their own stock.
Definitely one to watch. And anything major internationally.
Yeah, various bits of European economic data, key inflation numbers, CPI prints from different countries, more GDP figures, all important for gauging the health of the Eurozone economy.
Okay, so wrapping this all up, it feels like we're starting the week in a kind of complex spot. There's maybe some cautious optimism from that tariff delay.
Yeah, a bit of relief there.
Yeah.
But it's definitely weighed against these ongoing worries about the U.S. fiscal situation, that upward pressure we talked about on long bond yields, and the fact that central banks like the Fed and the BOJ seem to be on slightly different tracks, navigating different pressures.
So keeping a really close eye on all that data coming out this week and any hints from central bankers, that's going to be absolutely critical to figure out where things might be headed next.
For sure. And those sources, they really drove home how all these threads are connected. U.S. fiscal policy, those trade talks, what the Fed does, what the BOJ does. It's all swirling together and hitting the markets at the same time.
And here's a final thought, building on that fiscal point. Given the analysis we saw suggesting that, well, neither major U.S. political party seems truly focused on tackling that rising deficit path, what does that lack of a serious long-term plan mean? What does it mean for stability down the road? And maybe for how attractive U.S. assets look globally compared to other options for investors like you?
That's a big question.
It is. Definitely a lot to chew on as we move through this week.